2025 has become one of the toughest years in corporate America, with bankruptcies climbing to levels unseen in over a decade. Today, we break down what's driving this wave and how it affects the economy, businesses, and everyday people. Large U.S. corporate bankruptcies are on pace to reach their highest total since 2010. Over 650 filings have already occurred in 2025, and that number is expected to rise by year-end. This year is shaping up to be a turning point in corporate financial stability. Bankruptcy is more than a business headline. It signals stress in corporate credit, supply chains, and consumer spending. When big companies fail, workers, suppliers, lenders, and local communities feel the impact. Bankruptcies can create ripple effects across the entire economy. Companies typically file under Chapter 11 to restructure and stay functional, or Chapter 7 to liquidate and shut down completely. Most filings today are Chapter 11, showing companies are trying to survive, not disappear, but the damage is already done. There are three major reasons driving this surge. First, borrowing money is more expensive. High interest rates have made it harder for companies to refinance debt or raise funds. Even healthy companies are feeling the pressure. Second, inflation has weakened consumer spending. People are cutting back, demand is shrinking, and companies with thin margins are struggling to stay afloat. Third, supply chain disruptions and tariffs have increased costs for import-heavy industries. For many companies, it's simply become too expensive to operate at scale. This surge isn't limited to a single sector. Manufacturing, retail, transportation, healthcare, consumer goods, and even entertainment companies are being pushed to the edge. Some firms that were already weakened by the pandemic never fully recovered, and 2025 has pushed them over the line. A growing number of these filings involve companies with more than $1 billion in assets. These mega bankruptcies show that even America's biggest corporations are struggling. Big names and legacy brands are finding out that scale doesn't guarantee safety. It's not only large corporations. This year, more than 4,000 stores, restaurants, and small businesses have announced closures. Communities are seeing empty storefronts, job losses, and uncertainty in local economies. A rise in bankruptcies is often seen as a recession warning, but the picture is complicated. Some economic indicators, like GDP or stock market performance, still look strong. This shows how uneven the economy is right now. On the surface, things look stable, but underneath, there's pressure building. Economists are watching three signals closely: credit conditions, whether lenders tighten access to loans; business investment, whether companies delay expansion; consumer confidence, whether people keep spending or start saving. If these weaken further, the bankruptcy trend could accelerate.